Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Do I think that the stock market's going to go careering up, in which case I'd want to have more stocks in my portfolio? Or do I think we're in for a massive recession, in which case I'd probably want to keep my portfolio where it is? So I like to start by taking a step back, right back to 1983. And with this chart of the FTSE 100, this gives some good overall context of where we are. So we have here the famous Black Monday, which was then dwarfed by the dot-com bubble and the credit crisis. Now, of course, when the credit crisis played out in around 2008, the government used quantitative easing and low interest rates in what was essentially the rollout of modern monetary theory doctrine to then reinflate the economy. It then fell back into this linear line that we see and performed very strongly until the corona crash. Now, the government responded from the corona crash with more quantitative easing, and interest rates remained at near zero. And this is seen as a confirmation of the MMT doctrine of central banks and of governments. But just from this, really, it's hard to tell. I mean, if it was to go shooting back up, that would look in line. But also from this time point, for it to go careering down wouldn't look that odd either. News that it started climbing again quite sharply. I should also mention that with the FTSE 100, we've also got to consider that Brexit has happened. We got a really good deal at the end, and maybe that was dragging it down a bit. So now to give a quick overview of modern monetary theory. Now the first thing is it's all underpinned by the inference that the only reason why it's been working is because there's been massive deflationary forces dragging down inflation throughout the world caused by globalization and the rise of the internet and technology. So it's only because of this that it's been working. And what it actually is, well, the government's main priorities are to keep price inflation low and house prices stable. And I should also add to that GDP strong and stocks up. They've been able to achieve this by having zero interest rates now for many years, plus by, when needed, engaging in quantitative easing, where they just create money out of thin air and pump it into the economy via the banking system. And then also, as we've seen recently with the corona crisis, by all these free money handouts. So because of the deflationary forces, they've been able to perform all these measures which would traditionally have been inflationary, and stocks have been protected and GDP has been hobbled. It's not quite a totally free market. It's been hobbled a bit by the government's behaviour. So they've been able to meet their aims by doing this because of the deflationary forces. And at the same time, this has led to much larger fiscal deficits, more inefficient economies with all kinds of fake jobs and government jobs and this kind of thing, non-productive jobs. And it has led to some currency inflation, although as I'll show later, it's not been quite so bad. And the way I've conceptualized this is that this engine is great as long as it's working. But one thing is that currency inflation, if that got out of hand, then all of a sudden they would have to raise interest rates, and then the whole engine that's currently running at 1 million RPM will explode. So that's my summary of modern monetary theory based on all the different sources I've been researching. And I'm a little bit, and my stance has changed a bit from the last macro update I did. I feel like you could look at the Chinese Communist Party as an example of full MMT taken to its full extent, where they build whole cities even though there's no one to live in them to keep the economy and GDP propped up. But the Western governments are still a long way down the spectrum from that. What they've done so far is everything they think they can get away with. But I do feel that should the economy improve, then they'll start engaging in quantitative tightening and, as with the US did last time, start raising interest rates. So they will try and claw back the value in their economies once the emergency situation has ended. So as I said, my portfolio is currently 28% in stocks. And this is actually already by default a very defensive portfolio allocation. If the worst case happened and we had a currency collapse and then the economy just totally went down the toilet, that would mean that I'd only actually lose 14% from my overall portfolio, assuming all my stocks lost value by half. And if I meet my 20% target for how my stocks perform, then my overall portfolio would gain 6%, which is below target for my, but it still isn't that bad if we're in a worst case. And if I was wrong and everything went roaring and all my stocks doubled in value, then I'd actually be 28% up, even though I've got a tiny stock allocation. So if I have a medium risk balance and have 50% stocks, then you can see the worst case will be a quite nasty 25%, but the best case would be a 50% gain in my overall portfolio value. And if I go for a all hell MMT 80% stock portfolio, then the worst case outcome then would be a disastrous 40%. I'd probably have to give up this whole project, but it could be a considerable gains if that played out. So now the fortunate thing is that it's going to take me 3 months to research enough stocks to get some good ones to start investing in anyway. So I actually do have the privilege of time here, in that I can, while I'm busy doing some stock picking, I can just sit it out and look at how the macro factors progress in the first quarter. But then when it comes to the end of the first quarter, I'm going to have to make a decision as into how hard I start buying into stocks. But at least for the next quarter, I'm safely positioned anyway. So here's my UK dashboard, and you can see the interest rates, of course, rock bottom as ever. Quantitative easing increased quite a bit to 0.9 trillion in December. And we can see here that it really was quite a significant increase. There's a nice pattern here where you see GDP pumped up and then the FTSE seems to follow the GDP. Something else I noticed was that when we had the credit crunch, that successfully maintained GDP, at least on the sensitivity of my chart here. And that was, and you can see how dropping interest rates therefore had a big effect, whereas this time they couldn't drop interest rates anymore, and this massive increase in quantitative easing hasn't had such a cool effect. So inflation has been nice and low at 0.3% in November. House prices have stayed steady this year, and this does tie in with the theme of rich people staying richer throughout the corona crisis, while the people at the lower end of income are the ones that have suffered most. We see that in December, GDP dropped to 0.4%. And it has been fairly low. Although we did pump up GDP a bit, you can it's still not where it was before Corona started. But then historically, it's not that bad either. And unemployment in the UK has steadily climbed. So in 2020, it just steadily climbed, even when the lockdown was eased. And we're now at 5.5% with another lockdown in full effect. So we see here the GDP that I showed you before has been reasonably robust, but the government, in all of its stimulus measures, has now increased its debt quite considerably. The government's now 2.1 trillion in debt, and the fiscal deficit, so I mean this is the deficit on a monthly basis, is now the government spending 31.6 billion more than it receives in taxes every month. In a normal year, they'd be only spending 10 billion more. I've used the Office for National Statistics November bulletin. So to start out, you can see that their public sector net borrowing has been 31.6 billion in that month. And as we can see, that's 26 billion more than in a normal month. Also, their tax receipts were 40 billion. So that means, and that's 3 billion less than in November 2019. So this means that there's been a 10% drop in tax receipts. So that's interesting to me, because that does show you how the economy is hurting. There's 10% more business going on, 10% drop in tax receipts. And then on the government side, the government's spending 30%, the government's spending 29% a month more in its government spending than it would be normally. And so this is our 2.1 trillion of public sector net debt. And that here, as I've put as the fiscal deficit, is about 100% of GDP. But it hasn't actually changed that much ever since the corona started in February, because of some GDP growth. And here they have a nice graph where you can see the government debt as a percentage of GDP. And you can see, if you go back to the Depression and World War II, up here it was significantly higher. So it's not kind of end of the world levels, but it is still significantly higher than it was throughout the 80s and 90s. But this does give some nice context. And they have a nice breakdown of some of their government handouts they've been engaged in. So one was the COVID-19 corporate financing facility. And this provided big and medium-sized corporations with loans to help them as they had to be forced to be shut down. And this, on the one hand, yes, that helped keep these companies alive. On the other hand, these are now loans. So after the crisis is over, these companies are going to be more indebted. So even though the government foots the bill, in other words, the taxpayer foots the bill at the end of the day for these corporations who weren't saving for a rainy day, it still means that their risk profile will be changed after the crisis. So there will be structural damage. And the job retention scheme was where the government made payments to furlough workers. All these people sat at home doing nothing for 6 months, raking in 80% of their salary. And this was, though, a positive move because it kept people from being made unemployed. So it's understandable. Then there was a self-employment income support scheme. And this was where self-employed people, so I guess plumbers and builders and stuff, were given 80% of their usual income. And as far as I could make out, this was just a giveaway. Then, of course, there's the Eat Out to Help Out scheme, where everyone got these free vouchers so they could go out and get Domino's pizzas delivered to them. Plus another one is this bounce back loan scheme. So lots of small businesses in the UK have been given 50 grand loans to help tide them over. So on the one hand, again, yes, it does keep these businesses alive that were forced to shut down by the government action of enforcing the lockdown. But all these companies are indebted, so moving forward after the crisis, they'll be in a less good position for expansion and stuff. And also the bad businesses who were probably going to go bankrupt anyway, rather than being naturally cleared out by the corona crisis, will just end up going bankrupt anyway after the crisis is finished, and despite the taxpayer paying them a 50 grand loan. And then digging into the detail here, they have some nice numbers for the tax receipts, and we see VAT was down 13%, so that means a 13% drop in all the transactions happening. Alcohol, interestingly, was down 40%, and that's presumably because all the pubs were closed. I was interested to see that tobacco was the same as alcohol, and surprised because I thought people would just smoke at home anyway. Maybe they're vaping. And business rates, and this is the most important one, down 33%. So businesses in the UK, the money they've been making has been down 33%. So I think it was good to dig into the detail there to then give me a bit of context. And really my overall feeling is that although all of this government indebtedness has kept us from falling off a cliff, we've got another lockdown just in force now. So I'm thinking, what's the data going to be like when that finishes in a few months' time? You know, we see ever more quantitative easing, ever more government debt. So the government is at a even more compromised position before we finally get through this corona crisis, hopefully in the spring. It does mean that although the MMT has provided short-term effects, you wonder from digging down deep a bit, what really are the structural effects, the longer-term structural damage to our economy? You know, we'll have the positive effects of Brexit Britain, plus we'll have a positive boost of everyone going out and spending again after the end of the lockdown. But then I do worry how that's going to be tempered by structural damage. And it does kind of lead me towards thinking towards a choppy sideways rather than necessarily a massive pump up. So as I was saying, currency inflation is the one thing that I could think of to try and preempt the wheel falling off the MMT cart. And here I've got the pound sterling against the Swiss franc, and it's good to go back to 1994 because actually we look relatively stable these days compared with some of these things in the past. The credit crisis, for example, dropped 40% off the pound's value. So actually, it doesn't look like any signs of danger here. And then when I zoomed in, we've had about a 6% drop due to the corona crisis against the Swiss franc. So no apparent danger really at the moment. And then against the Singapore dollar, there was no effect. And the only thing I noticed here was a 12% drop since the Brexit vote. So moving on to the US, and they've also got near zero interest rates. Their QE has been up as well, but you know it only really jumped up during the last lockdown, which happened in around the March-April time. So we see here the US GDP and the stock market responding to it, and their quantitative easing jumped up. It doubled, actually, the same as us. Oh, interestingly, the Feds had pumped up their interest rate a bit prior to the lockdown, and you can see then how the Feds reducing of their interest rates, which they could do, which the UK couldn't do because we were at zero already. That does explain why the US economy seems to have responded better than the UK economy. And interestingly, the US stock market is looking crazy, and I'll come into that in more detail. But was that somehow related to interest rates when you compare that with the UK situation, where it never went back up to the top like the Americans stock market did? Was that because of they had the ability to drop interest rates, or was that just because of Brexit, or was that because the S&P 500 is dominated by FANG stocks like Tesla? Not sure, but an interesting thought. So US inflation increased to 1.3%, still lower than the 2.3% at the beginning of the year. So you can see there's kind of an example of structural damage. House prices up in the US. Now the GDP of the US is forecast to be 11% in November, and that seems very high. And so the US seems to have had a sharp jump back. But of course, we're now into a new lockdown, so you can expect them. So you can expect them to have a sharp drop down again. And their unemployment now, compared with the UK, the unemployment situation in the US got a hell of a lot worse. It was at 14.7% in April, but then when we got to November, December, it's been a fairly steady 6.7%. So their unemployment situation's worse than the UK, but it seems to be trending better than the UK. The UK has only been getting worse and worse, but at a steady rate. Whereas in the US, unemployment jumped up massively, but then recovered really quickly. You could say that the unemployment is less stable in the US than in the UK, and tends to be a bit higher in the US than in the UK. So the fiscal deficit of the US is now 130%. So that's actually better than in previous quarters. And that's explained by their large improvements in GDP. And their fiscal deficit, again, they're spending 145 billion, where more typical would have been something like 50 billion. But their massive debt, it only, as a proportion of GDP, isn't that much of an increase. And there's the kind of linear line we saw with the FTSE, we're way off that. So this looks a lot more alarming than the FTSE 100 does. And it makes me worry. I mean, one thing in particular is, now it's well reported that the main stocks that did really well during the corona were the FANG stocks, so Amazon, Facebook. So this does explain this, because they were fairly immune to the corona crisis. But they are all the same extremely overvalued at the moment in terms of their price to earnings values. One narrative I can't help but consider is, what if we get a FANG stock bust, the same that there was a .com bust? That is certainly one possibility that looks more likely the more this shoots up, almost parabolically. And it was interesting that observation I just made whilst doing this video about the interest rates. That's something which the US had in their arsenal before, which they don't this time, now that we're going into a Joe Biden style lockdown. The S&P really does not inspire confidence to me. and we know that if things went wrong there, then that will have an effect on the FTSE where I'm investing. The news that GDP would be minus 31%. I remember that well when that news release came out. The stock market actually kept on pumping when that news came out. People say that the stock markets lead the economy and lead the GDP figures, and that's certainly proof of that. But then it's interesting, then when I go back to the UK and consider what I want to do with my stocks, we've just entered a lockdown now. So does that mean we could be in for a real nasty drop because of that? To be honest, I'm only afraid of what I see here with the S&P 500. Now the S&P 500 looks a lot better when we look at only the last 2 years, and we can see here that the Biden win and vaccine news was the main news event before it pumped up. An interesting thing about the virus news, the stock market increasing on that, I'm a little suspicious of. And the reason I say that is because if you look at the corona data for the UK, we can see that the cases are, well higher than they were when we had the initial corona shutdown. Just look, these numbers we've gone up from 4.7 thousand cases a day to 62,000 cases a day. That's 12 times as many people currently with the virus. And despite that, the number of deaths is generally less than it was the last time round. And of course, we know that normally when the flu season happens, these flus tend to mutate and spread more, but become less dangerous as they spread more. That's the well-established fact for the flu seasons, and it seems to make common sense that the same would happen with the coronavirus. So anyway, the interesting thing for me is it seems hard to believe that the population won't have sufficient immunity built in after this flu season. And the interesting thing is everyone's getting vaccinated now, but by the time enough people are vaccinated for that to have had effect, we would already have been in lockdown for a couple of months. So although the vaccine news pumped the markets, the vaccine hasn't actually had any effect on the economy over the next 3 months, because over the next 3 months we're all stuck in lockdown anyway, vaccine or no vaccine. And so that makes me think that we'll still have a nasty set of effects, just like we did after the last knockdown. That should get repeated, vaccine or no vaccine, and the data from that must be emerging only now. So anyway, just to return then to the US, in terms of their currency, they've had a 10% drop from the currency crisis. But again, when you look at historical context, that's nothing too bad. And over the course of the last year, there's been a steady decline against the Swiss franc, and the US has dropped 10%. But still, it's not yet emergency levels. So when I go back to the first slide, going through the numbers and just seeing how ugly things are, like the government debt and unemployment and gross domestic product, it looks so bad across the board. Then the other thing is, everyone's telling us that modern monetary theory saves the day anyway, and stocks always go up anyway. And I feel between those two, I think my gut feeling at the moment is more like a choppy sideways. It's so hard. Even if I was a qualified expert, it'd be so hard to try and predict macro. But I try and do my best with, and and you've got to do something to try and decide how much stocks you want in your overall portfolio, even if you're an amateur. Still, anyway, I'm lucky in that I've got the gift of time, in that I won't be able to do anything anyway for the next 3 months. So I'll just do what I can to gather more data and then make a decision in the end of the first quarter how fast I start buying stocks. So to summarize, zero interest rates, quantitative easing, and all of these stimulus handouts, plus risk-free loans, have been deployed to keep GDP and stocks up. This is the cost of massive government debt and minor devaluation of the US dollar and pound sterling. When I say minor devaluation, 10% of every pound that you earned has lost its value in the last year. Now, a post-corona and Brexit boost seems obvious, but also there's definitely structural damage to the economy once the government loans are taken away. MMT, we've gone into the theory behind that, but we need to keep an eye on it. I like to summarize again that MMT this year has meant that for every pound you owe, it's lost 10% of its value. As long as price and currency inflation is low, governments will still keep on doing this MMT. But I do also think that once the emergency time's over, if they've got away with MMT, and that's still an if for now, then they will embark on quantitative tightening and maybe some interest rate increases to help add quality to the country's economy again. And so, in conclusion, I'm defensively positioned anyway, only 28% in stocks, and I have the luxury of time whilst I research some new trading ideas. Therefore, I can enjoy watching what happens over the next 3 months and be ready to start buying stocks again, if appropriate, in quarter two, following a reassessment of the macro landscape.